Hey traders, Ivan Delgado, Head of Market Research at Global Prime Forex. Hope you all doing great. I put together a chart exercise looking at the Euro-Dollar hourly chart going all the way back to the late November until present time. Okay, now this is a practice that I wanted to put together on the back of yesterday's more theoretical explanation about how I personally read market structures. Remember, reading structure in the market is not fixed in stone. There are many interpretations. This is just my personal one that I found to be quite mechanical. So hopefully you find value in the little bits and pieces that I'm going to be sharing with you. Now, getting to the nitty and gritty, I have annotated here on the top right hand corner 6 main considerations you want to give to your charts every single time whenever you analyze. Now remember, if you want to have a more detailed explanation, just go back to this article. You have all the explanation there. Now back to the chart. These 6 points are always look to cross-check higher time frames, and here a rule of thumb is to have 2 time frames above. Okay, so if you're going to be trading the hourly, you want to understand what are the conditions on the 4-hour and at the same time on the daily. Second of all, is the cycle being confirmed or not? The third is, are we facing clusters of levels nearby that may disturb the current cycle at play? Now the fourth is looking into the trend lines. Notice how I've drawn 3 trend lines in this chart, and each one gets to be, to a certain extent, being respected. And you will understand as I go further on my explanation how the third touch of a trend line tends to be the most powerful one. Okay, always the rule of 3 is one that applies in, well, not always, but in the majority of cases. And you will notice how striking it is, the accuracy that number 3 has on Forex trading. Okay, either it is on trend line testing, either it is in potential compressions of the price before a turnaround, etc. Okay, but sorry, I'm going a bit off the tangent here, so let's just keep the focus on the 5th point, which is magnitude of the cycle. In other words, how strong is the move away from a potential range, or whenever there's a turnaround, how strong it is. And 6, velocity. Is it very impulsive, or is it actually evolving in a very compressive and in a very compressive manner, that is. Okay, so now let's get, without further ado, into the analysis of this chart. Notice how many arrows and boxes. By the end of this exercise, I guarantee that you will develop a deeper understanding about what all this painting and markups is all about. Okay, so to always and whenever it comes to understanding a market cycle, you always must find a point in your chart that is going to represent your starting point. Okay, so let's just consider this one to be our starting point, and here we have our first low, and this is our first high. Therefore, we are breaking this low, so we are creating lower lows, and here we come up, we make a retracement which happens to be above the 50% retracement. Therefore, we will be validating this high as a lower high, and then we make lower lows, and then we have once again a lower high, which is validated because if we were to retrace a 50% Fibonacci, it crosses above, and then we have a very impulsive sharp move to the downside that goes all the way down to about 1.1540. And now key here is, what are we going to be understanding as the next swing high? Is it going to be us just basically visually determining that, so that would be our determination as the next one, or do we want to use a little bit more of a mechanical approach? And here's where it comes my kind of exceptional, if you like, way of looking at the charts. I drew a Fibonacci retracement, and as long as it doesn't make it to the 50, and remember, in this be reminded that in this exercise I've been extremely detailed, so it doesn't make it by 1 or 2 pips, so I don't consider that to be a valid swing high. Okay, now that's up to one's interpretation. touch for me because I need to respect the 50% retracement rule to validate highs or lows. Okay, so this is the next high that will be validated. Notice how if we were to draw the line, it obviously go way past the 50% retracement. Okay, then we come down and we retest these lows, but notice how we never actually have two closes below this latest previous low, which would have been validating otherwise this this leg lower. Okay, then what we find, where we find ourselves is that the price makes an impulsive rebound, and the moment that this rebound after a double bottom breaks the 50% retracement, that's evidence that we are transitioning into a range, and that is when the range begins. Now initially the range is not that narrow, that compressed, but rather this would have been the range. But notice how then here we have another double bottom, and then the 50% retracement is broken. So that's why I kind of I've drawn and I have narrowed this box a little bit on the example drawn here in the chart. Okay, now basically what we've done here, we've seen what price done is we transition from a down cycle into a range, and now we need to determine what's going to be the next direction in the price. So basically we need to be waiting for the new cycle to develop by a break of either this high or this lows. Now if you're going to be trading within a cycle, I always suggest that you trade either the edges or if there's enough evidence that the 50% is holding, you might be trading off the 50%, but just don't get trapped in the rest of the noise within this box. Okay, now we break higher and notice where price ends up going to the 100% Fibonacci projection target, which by the end of this exercise you'll notice how critically important it is for you to monitor. And the way you calculate it is you draw a Fibonacci from the low to the high of a range box, and the 100% projection, that's where most likely you will see sellers stepping in, and when combined with buyers taking profits, that creates some type of synergic move that more often than not will pull prices back somehow to the mean, obviously subject to fundamentals and other news events that might be at play in the market. So we've seen this lower this low being made, and obviously it goes beyond the 50% retracement. If we actually went to retrace this one, to draw this Fibonacci, it goes, as you notice, below the 50% retracement. What this means is that this low is going to be validated, and at the same time it is for you a good reminder to notice how the third touch of the trend line is what's causing this rebound, or at least that's the place. It's not that the trend line is causing it, but that's certainly a positioning in the chart that will be attracting significant interest. It is a pristine area where there's potential to be engaged in buy-side action. Okay, so then we have a rebound to the upside, and we are not breaking. So what we have here is a double top. So when we have a double top around a context of validated swing highs and swing lows, then we can draw a retracement, the 50%. So basically this would be the retracement, and the moment that we break below this 50% retracement, that's when we confirm that we are in a range within the context of an upcycle. Now this would have been our initial range, but notice how we again have a double bottom. So the moment that you have this double bottom and we break above the 50% of this area right there, here you would have confirmed this more narrow range. Okay, so then we break higher, and again, let me just clean up a little bit this chart. Again, where is price? Where is the destination of price to the 100% Fibonacci projection target? And not only in the first touch, but then subsequently we also have another touch there, almost coming really close again. And here we had a break, but it's just price didn't find any acceptance whatsoever. Now we transition from an upcycle into a range. When is that? Well, the moment that we have a fail, a double top, and we retrace beyond the 50% retracement based on the last swing low and the last swing high. Validated, remember, always by the 50% rule, okay? Now, the moment that we break outside this range is when we start to develop a new down cycle. This move was extremely low, extremely sharp in nature, as you can see by the movement, by the velocity of this movement. There was no retracement at all that would have met the 50% rule, not even here, not even here. So there's one little nuance that I have pointed out in my article, that being that if the price movement goes, let's just say a couple of times the ADR or even beyond that. So in this case, we had a move of almost 300 pips in euro dollar without any type of retracement. Here the rule that applies would be that as long as we have then a rebound that goes at least or very close to one daily average range of the euro, then we can actually qualify this move as a validated swing high, and that's what we see here. And also at the same time, notice how that would have been the third touch of a trend line. Okay, so that's our next validated high from this move. So it took actually, if we were to analyze this move, it took almost 100 bars, which is about 4 days. So it took about 4 days to have the first validated high. But look, listen, this is the way that if you are going to approach markets, sometimes you will have just to ignore this high as being a validated one and this high being a validated one. You would have noticed that here we had a double top and then we break below the 50%. So some people might have considered, and there's nothing wrong with it, that this would have been another range. But again, if it doesn't respect the 50%, I just don't consider that to be a range. I still consider that to be a down cycle, okay? And that's why I always point out that we can actually generate ranges. The formation can occur as long as we have validation of swings around the ranges, okay? So then what we do is, like, the price makes a lower low, so that the cycle keeps evolving, and we rebound. And in this rebound is interesting because we are going to form a range. The range will be formed when, after getting this high that gets confirmed, then we go and we make a new low that also gets confirmed. Notice how here this would have been 50% retracement, so the high is confirmed, and on the way down there would have been also, sorry, let me grab the Fibonacci retracement. So on the way down, this one would have also been a confirmed low, okay? So that's why whenever we then break the 50% retracement, that's when the range is being confirmed. But notice how we break outside of the range, and then we have a retracement, and this retracement makes it just to the tick to the 50%. So what do? We validate this high and then this new low, and the cycle continues lower. Notice now, this is very interesting before I conclude this video. This is the 400 Fibonacci projection target, and not only it's being respected, but the 300 and the 200, they're all being respected. The 100 gave us a little bit of a red flag because it wasn't respected. So on the rebound, since there was so much intensity behind the selling, then it acted as the immediate resistance right there, okay? But otherwise, the 200, 300, and 400 Fibonacci projection targets have all served really well in indicating when the market might be turning around, sellers taking profits, and buyers, the scalpers, and those that are just wanting to have like that kind of interest for a short-term trade are going to be stepping into the market, okay? Now, the 400 Fibonacci projection target more often than not really constitutes an area where we might see a more significant rebound. And what we've seen ever since the price touched the level is the hourly chart is starting to see a few cracks. Not only it is the first time that the downtrend is being broken, but at the same time, since we had a validated high and a validated low, by making higher highs right here, now officially it is the very first time, and it's important for you to pay attention. It is the very first time since September the 24th, and now is October the 10th. It is the first time that the euro dollar is starting to play with a bullish cycle. Okay, it's starting to develop a bullish cycle. The very first time since September the 24th. Okay, so hopefully by the end of this exercise, you have your understanding of market structures have evolved. This is a lot of information. What I suggest is that you practice over and over, and you get better and at perfecting your craft. If this is an area that you might be interested, so that you can pick better locations to engage in the market, this is certainly a very valuable exercise for you. Okay, now when it comes to the actual entry trigger, and something that I go through on this theoretical explanation of the exercise, which also includes some great examples in each single section, I also go through how you can trade these market cycles. Okay, now there are thousands of ways you can approach the markets when it comes to finding your entry trigger. It could be based on trend lines, price formations, price action, set or buy limit orders, you name it. So that's more kind of down to your own discretion. I will certainly be making and producing more content that will be looking into different types of entries that you can be looking into. But at the end of the day, this is a self-journey exercise that you also have to, take up, and need to decide and define what is best for you. Okay, in terms of what makes the most sense, what's most sensible to you. Okay. So that being said, hopefully this has been a enlightening exercise for some of you. And until the next video, it's bye for me. Thanks.